Hi, and welcome back to the Food Fund, where we analyze investing in food, beverage, and restaurant stocks. In this video, we will be evaluating the portfolio performance for June 2025. The portfolio continued to grow, and I added a holding to the portfolio, so be sure to watch through the end of the video to find out which stock I bought. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now let's get started. Cue the logo. Let's start off with the market's performance. For the month of June, the S&P 500 gained about 4.6%. The market recovered well from the large dip in April and raced to a new all-time high. When we look at the companies that make up the S&P 500, we can see that there were big gains in tech again. Companies like Microsoft, Nvidia, Apple, Amazon, Alphabet, and Meta all gained a lot. Over in our corner of the market, non-alcoholic beverage, alcoholic beverage, and consumer packaged food companies all fell, while farm products, confectionery, and restaurant companies gained. June also had some notable earnings reports. Darden Restaurants, home to a large portfolio of popular restaurants, logged a good earnings report. Earnings per share came in at $2.98, beating estimates of $2.96. This value also represented a 12% increase from the same quarter a year ago. Revenue came in at $3.27 billion, just barely beating estimates of $3.26 billion. Let's hear what CNBC had to say about the earnings beat.
Good morning. A beat on the top and bottom lines for Olive Garden parent Darden, driven by same-store sales gains, which were up 4.6% overall. Olive Garden up 6.9%, leading the pack. Its same-store sales guidance was in line, but EPS was slightly below consensus for the full year.
Same-store sales growth is super important for restaurant companies and is one of the metrics I follow closely. Additionally, it seems that management is planning to ride the momentum and accelerate opening new Olive Garden and Longhorn Steakhouse locations. This is great news for shareholders. Okay, let's move on to the portfolio performance. I deposited $100 into the account on June 1st, 2025, and at the end of the month, the portfolio balance was $1,392.66. This means the portfolio gained $103.74 for the month, representing an 8% gain for June. It feels great to generate strong returns. Given the S&P 500's 4.6% return, we gained 3.4 percentage points of alpha by following our strategy and not being invested in the S&P 500 this month. Our streak of outperforming the S&P 500 has hit 5 months in a row. Gotta love that. Looking at our performance chart versus the S&P 500, we see that we have breaking away with further outperformance. We were heavily trailing the benchmark until March. Since then, our gains haven't looked back. Since inception, the portfolio has had a 15.6% return on a money-weighted basis, while the return on a time-weighted basis was 16.1%. Given the S&P 500 13.3% return, we have gained 2.3% of alpha since inception by investing in my portfolio and not investing in the S&P 500. And given that this is the 12th month of running this portfolio, we have officially beat the S&P 500 on a one-year basis and have a compound annual growth rate of 15.6% for the portfolio since inceptions. Congratulations to me! Now let's look at the portfolio moves for the month. Here are my portfolio moves for the month. Feel free to pause the video and rewatch to catch all of my portfolio moves. Okay, let's take a look at some key holdings in the portfolio. Celsius remains my largest holding. With 6.59 shares at a cost basis of $32.08, this position is up 44.6%. Celsius makes up 21.9% of the portfolio. I'm happy with this portfolio weight and would only add if the share price fell significantly. Next, we have Pepsi. Pepsi is my number 2 holding with 2.21 shares at a cost basis of $143.29. This position is down 7.9%. Pepsi makes up a massive 20.9% of the portfolio. Pepsi is a very slow-growing company, but the recent pullback was an opportunity for me to lower my cost basis. Still, I am not trying to add to the position, but cannot pass up a good opportunity to lower my cost basis. I do not want this position to get much larger than 20% of the portfolio. Skipping down to Chipotle. The Mexican restaurant is my number 4 holding with 2.85 shares at a cost basis of $50.73. This position is up 10.7%. Chipotle makes up 11.5% of the portfolio. Chipotle has been a really great position for me. It has been a strong, steady presence in my portfolio, and I always end the month wishing I had bought more. Now let's talk about my new position, Kava. Kava is my number 6 holding with 1.01 shares at a cost basis of $73.69. This position is up 14.3%. Kava makes up 6.1% of the portfolio. Kava is a company I stayed away from for a long time. I wasn't particularly fond of their food, and their total addressable market is a tenth of what Chipotle can achieve. However, when I reviewed the fundamentals, Kava was growing quickly, profitably, and efficiently, and the drawdown gave me a great entry into the stock. Though I don't see Kava matching the performance of Chipotle long term, the next 5 years have tremendous growth ahead for the company. Last, let's look at the cash position. I deployed way more cash in June than last month and have a cash position of $41.11. This makes up 3% of the portfolio, down from the 11% cash position I held last month. Ideally, I'd like to be fully deployed in equities, but I'm okay holding 5% to 10% in cash. As far as the weighted average metrics for the portfolio, cash conversion cycle and net debt to EBITDA are improved since last month. Free cash flow per share growth and return on invested capital are slightly worse, but gross margin, revenue per share growth, and yield on cost were unchanged. Zooming out, the past 12 months of running the portfolio have been both challenging and awesomely rewarding. I fell behind early and really didn't start to catch up until Celsius went on a tear after bottoming in early February. Had I not continued to buy and lower my cost basis as Celsius fell further and further last year, my portfolio would not be in as good of shape now. One interesting way I have been able to track my portfolio progress over the year is to review the change in the weighted average metrics. You can think of weighted average metrics as the metrics if there was a single company that comprised my entire portfolio. I started with high gross margins and rapid revenue and free cash flow growth. Return on invested capital was super high, but the cash conversion cycle did not show good efficiency. The net debt to EBITDA of 1 was pretty good, and the yield on cost was high at 2.9%. In retrospect, my early portfolio was heavily weighted towards mature companies that had great gross margins and high return on invested capital. However, the performance of that portfolio was poor, so I decided to move to a more growth-oriented portfolio, as evidenced by return on invested capital declining but cash conversion cycle improving. Essentially, I have sacrificed a current high yield on cost for a future where my yield on cost should grow much faster. We'll see how it turns out. 1 year of building and tracking this portfolio went by super quickly, and I learned a lot. Many thanks to all who watched this video series, especially those who watched from the beginning. What do you think about the portfolio? Share your thoughts below. It is always great to hear from you. Check out some more videos right now, and don't forget to put your money where your mouth is.